Hey, hello. This is Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we look at the technical charts and then try to understand what happened in the market in the previous week, and then also try to plan for a better trading week for the week that's starting from tomorrow, Monday, April 22nd, 2024. So let's get into the charts. This is a weekly view, which we had been seeing since quite some time now. It's a cup and handle and followed by multiple flag breakouts that's seen on Nifty and Banknifty on the right side. And we have seen that the last breakout or the flag breakout did not sustain and seems to have fallen down a bit. Here is another view of the weekly indices charts where we see that the same. We see the price almost reaching the top of the channel, while Banknifty lagging behind a bit, but trying to break out of that and then not able to do that. This is a daily view. We see there is some consolidations and breakouts that had been happening since quite some time. Actually, it's a bull rally that is happening with more volatility seen in the bank index, but even bank index had made an all-time high, but the last 4-5 days had not been the break for both the indices, is what we're seeing here. So if you see the weekly candles, you can see the Nifty on the left side has formed a red hammer. Not exactly at the very top, but still at the top of the rally. Red hammer indicates a longer wick size, which indicate the buying that happens in supports that are strong, is what is indicating. But if it's at the very top of a rally, we could think of that as a potential reversal in case if it confirms the price moving below the candle's low. And a similar hammer is also formed on the Banknifty also, not quite far from the very top of all-time highs. So the wick size indicates the drama that happened last week. It also indicates the reversal, the dip and reversal that happened last week intraday. This is how the price action looked. It was a truncated weekend. Left side Nifty is indicating that it was nose diving fall that continued till the Friday when the bounce up happened, and the last candle is very bullish, wide range bullish, and also it's a piercing candle. It doesn't look like a dead cat bounce. It's very strong buy on dips that happened without breaking the higher high pattern. And the swing low was at 21,700, and the bounce up happened much before that. The same happened on the Banknifty also. So the candle is very bullish, wide range candle with the piercing panel making it even more bullish. And the question is whether that will sustain and will the market further move up from here, or will it again fall back to where it had almost retested the previous swing low. So that also indicates that we had multiple gap downs for 3-4 days, and then one of those previous gaps was also closed last week, and you have another one out there. Right. So here the Bollinger Bands of the daily shows absolute contraction. That means sideways with a bearish bias because it's less than the 20 moving average on both of that, right side Banknifty, left side Nifty. So here also it's contraction. The bands of the daily Bollinger Bands were expanding till now, but it is now clearly showing contraction. That means probably in short term we are expecting a sideways movement within this range, and we may see some contraction further narrowing down the range of the bands also. But right now the band in the Banknifty is quite big, right? So the movement in the sideways would be also very violent, as unless and until this more skews or contraction happens in the bullish bands from Banknifty. But Nifty clearly the bearish bias sideways movement is what we see right now. We'll come back to this, finding the support and resistance levels of the indices, but before that, let's wrap it up. So we had a big gap down last week. Remember, this was following poor global cues that came in with news flows regarding the Israel-Iran conflict news that is floating around, which might have settled to some extent now, but that caused the 3.28% of gap down last week as a continuation of the previous week's gap down. Previous week's bearish candle, which is actually a gravestone doji in the Banknifty. Nifty also just kind of inverted hammer, and that got confirmed when this week such a big gap down of 3.3% gap down happened. But to surprise, when all expecting more corrections to happen, that's when the big recovery and bounce up happened, which recovered almost half of what was lost. And the highest correction still remains 4.5%. So the correction of this retracement is less than that. And red hammer weekly is the candlestick that we have the negative close of 1.63% loss, 367% loss previous week, and it managed to maintain that weekly exponential moving average of 20. So remember, we had a rally of 35% of Nifty with cup and handle, and then breakout from there with multiple flat patterns. Banknifty also gapped down, and that gap down was even more severe with 4% of loss, and 4% from the all-time high is what it lost. But it bounced back and regained 2% of that, half of that, and still it maintained the correction is less than the 8.8% that happened previously. And it's a red hammer again there with the negative close, losing nearly 1,000 points, 2% lost. So it's a big cut, bigger cut that happened in the Banknifty. And remember, it also had made 28% of rally from the cup and handle and the multiple flat breakdown. In fact, it did make a new all-time high just above the 49,000, but couldn't sustain that. So the breakout of the Banknifty did not sustain that's immediate to that the pullback happened. In the daily time frames, it shows a gap down on Friday and then a big recovery of 1% and positive close of nearly 0.7%, and that's 151 points gain, forming a wide range bullish and a piercing candle pattern, but it's below the 20 exponential moving average. Banknifty also did a recovery of 1% of the initial gap down, close positive 1%, that's 500 points up, and formed again a piercing candle and the wide range bullish candle, but below the 20 exponential moving average. So the poor global cues of last week caused the market gap down from the near all-time highs just a week before, and then it recovered half of that, but there is still not confirmation of the end of the correction yet, although the candle is bullish on Friday, really bullish, but it's not confirmed yet, given the fact that the short-term bearish moves the last 4 indices hit the momentum and the trend to the bear zones, at least the trend to the bear zones, and momentum went towards the bear zones but did a quick recovery in the short-term charts from the RSI 40 nearby levels from both the indices. So the question is going to be it's clearly Bollinger Band showing consolidation, so it could consolidate with violent moves up and down, or it could slowly make move towards the top and slowly expanding the Bollinger Band on the upside. So which way would that happen? So market has a lot of events that's ahead, and May 1st of that's the next week basically. May 1st, we have the Fed rate cut news that would come out. We have election outcomes and post polls that would come throughout the next full month, and you also have quarterly results that has already started flowing in month of April and next 3-4 weeks. So this is going to make the markets volatile, right? And this, if it turns out as taken by the market in a positive way, this recovery may sustain. That's what it looks like. So yeah, so let's move ahead and see the support resistance levels. So the Nifty, you have the first resistance that would come in at 22,300, which is 20 exponential moving average, and after that you have 22,500, which has got a gap resistance, right? So and after that you have 22,775, which is the previous all-time high. Those are the resistance for the next week. Downside, the supports breach down. Further down, we'll find some support at 21,710, which is the previous swing low. And if that's breach, it could go as low as 21,622, which is the 100 exponential moving average. And then Fibonacci 38 retracement supports could come in at 21,250, 21,250 zones. You also have a swing low at 21,500, right? And 200 exponential moving average is way down at 2,654. That's some resistances. So Nifty and Banknifty, the first resistance will be the gap. First, it has to take out the 20 exponential moving average at 47,635. Then it will be the 48,000 rounding number, big rounding number resistance, and then 48,500 nearby, which is for a gap resistance that is formed when the previous fall happened. And if that's taken out, then it heads to the all-time highs and the big rounding numbers at 49,057, 49,000 levels. On the downside, the first support, right, would come in at 46. First would be the 47,000, of course, with a big rounding number, and then 47,170 has got 50 exponential moving average support, and then 46,600 has got 100 exponential moving average. And then if they all breach and it's going to hit the previous swing low, then it can fall as low as 45,729 with the 200 exponential moving average is that. 46,000 big rounding number has got as support as well. So that's all the support resistance levels for the Banknifty. So if you study the momentum and the trend indicators, the RSI, the ADX of the indices on the higher in the long time frames, and in the medium term and the short term time frames, the weekly and the daily respectively, we can see that the momentum has dipped definitely in the Nifty weekly, but Banknifty has dipped even more by slipping slightly the sideways. On the short term, it had dipped in the sideways earlier, but you can see that it has taken a support very close to the RSI support zones near the 40 and then bounced up. It's taken as RSI support and bounced up. And ADX, you can see that it has crossed out the peer zones. And that's the DMI negative zones on both time frames, on weekly as well as the daily. And the bearishness is having more strength than expected on both Nifty and the Banknifty in the short term. And bearishness is not having that strength, and the strength of that is falling in the case of medium term. So short term clear crossover bear zones continues to be there. And right, so the trend is bearish basically. Trend is absolutely bearish. Momentum is sideways. Trend is bearish and momentum is sideways. But the only thing is, on the medium term, momentum is still bullish on Nifty alone. That's the only thing, right? So sideways momentum and bearish. So that's what has happened because of the price action for the last few weeks of correction. Moving ahead, we'll try to understand what the volatility index of the VIX is talking about, and then the open interest analysis following that. So India VIX has spiked up 16.5%. So it's a big spike for a week. It's 13.46. Suddenly it seems to be getting out of the low volatility regime. It's heading towards the medium term or the larger high volatility regime zones. So you have to keep a watch out on that. If you study the implied volatility, you realize volatility spread difference. It's still 20%, not much in favor. The IV percentile is 75, gives some hope for the option sellers. The open interest for the Nifty is showing, on the futures is showing a short covering, which is kind of bullish in nature. And open interest for the Banknifty and the Nifty monthly expiry that's coming on April 24th and 25th. That's got a put call ratio which is very close to the bull zones of 1, right? So open interest and on options and the futures are giving call for the bulls, but the VIX has spiked up. You need to be cautious about the fact that usually the market falls down, the VIX would spike. So this is exactly what has happened, but very be cautious as to if it's climbing back to the 16 plus above and heading towards 20, then you need to be extremely cautious on the fact, especially due to the fact there are a lot of events that's coming out close by in the May month. Open interest options data is clearly indicating huge resistance being built out on both indices, and the highest support and resistance can be seen at 22,000 and 23,000. That's what the highest put and call writing is seen, and the second highest put writing is at 21,000, call writing is at 22,500. So it's not a wide range. You can say it's 1,000 points range. That's what the price action is taking in. 47,000, 48,000. It's not again very wide range considering the fact that it's Banknifty. That's where the highest put and call support. Put and call writing is happening. 47,000 and 48,000. Second highest at 45,000 and 49,000. So that second highest is where the highest put call writing is having a very wide range. So that means if if it all, so you got to focus on the highest number of put and call writing. What is it, right? That's what we got to focus on, right? So how long there is bullishness? There is a reasonable range where the market is playing around, right? Support zones and resistance zones. Although there's huge resistance build-up that happened, the balance is seeing good support. Put writing also is good, added up, can clearly be seen. Let's now see how the sectoral indices performed last week. So it was down on all of the major sectors, including the IT down, metal down, auto down, pharma down, FMCG down, and realty down. But what went down the most was IT. It's a 4.7% down fall, and realty also hit hard by falling 3%. And what went least was the metal, which is less than 0.5%. So none of the sectors, other than the metal, which had fallen, which has formed a doji indice candle, that's the only place where we could take some long positions. Otherwise, the IT, the auto, right, pharma, FMCG, and realty, all of them have lost the momentum on the bullish side, and then we'll have to wait before taking, because we need both of the time frames should have the above RSI 60 bullish momentum for long positions to be taken. Neither, so it's sideways. None of them have fallen to the bear zones also, except for the pharma, which is short-term bear zones, and IT, which has got short-term bear zones. So medium term, none of them are bearish, but short-term IT and the pharma has got hit. So that's how we feel. So across the sector, it had hit badly, but except for the ITA and pharma in the short term, none of them have yet gone to the bear zones, right? So medium term, see, it's like almost all of them are either sideways or bullish. Look at this. So that's the same sectoral indices that we see. IT is forming a cup and handle, going to be sideways and slip down, that what got hit badly last week. Momentum is sideways and falling, not bearish yet. And then comes the metal, which is I think had been breaking out of the red shoulder. Momentum is absolutely bullish. Although at the very top, momentum is bullish, trend is bullish. Pharma and some retracement at the top, still momentum is absolutely bullish. Although trend is about to close over the bear zones in FMCG also. And the retracement continues with that slowly, but still sideways and falling in the medium term. If in reality still managed to hold at the top, momentum absolutely bullish and rising in the medium term. Let's now see the heavyweight stocks that contribute maximum to the indexes. Begin with the HDFC Bank. Reasonably good performance previous week with momentum trying to rise up. Volumes are also have increased with that. So HDFC moves have helped the market not falling drastically. Remember, it had been trying to move up, and in fact, moved much above the 50.45 earlier and heading towards in the bull zones. That's when it got hit back, and it's facing resistance once again. Long way to go before it becomes bullish on the medium term. Lines at the very top formed a kind of bullish green candle with momentum also remaining bullish. As you see, also it got hit, but still maintaining bullish momentum in the medium term. So lines in ICC absolutely bullish because of the momentum. Green close and rising sideways up is HDFC. But what got hit really was the Infosys and the TCS. TCS is sideways slipping down. Infosys in fact falling to the bear zones on the medium term as well. So IT got hit really bad. Right? Kodak Bank is sideways as usual. ITC also sideways but falling. Seems like it wants to go further down once again to the 400 zones and then move up. Sideways momentum in the medium term. So yeah, sideways HDFC and ITC and Kodak Bank, and really hit badly in Fee and TCS, and a bullish 2-0 Reliance and HDFC Bank. That's also not a bad picture at all in heavyweights, except the IT. Mid cap and small cap had gone through a correction in the March, but quick recovery and then the momentum back to bullishness, and both of them we can clearly see it's at the very top. Now I'll show you how the institutions participation. This has gone really bad, right? We had some 7,000 crores of cash market selling in the Fyers last week. Now we have nearly 12,000 crores of cash market selling again this week. DAs have managed to be buyers of nearly 9,000 crores, but net longs and derivatives has moved down last week. Institutions, especially the foreign institutions, are not participating well is the reason why the market struggles. Probably they're waiting for the Fed rate cuts and things like that. Let's now move ahead and try to see the global markets, commodities and currencies, etc. Beginning with the currencies, it was another green spike, small spike in the dollar index and set 106 above, bullish and rising momentum. Not that great news for emerging markets like ours. USD INR, that's the rupee, remains to be weak, but it has cooled down 0.22% at 282. I have it down here. Let me just quickly recheck that fact. USD INR is 83.3. That's correct. So it was a cool off, although the dollar had spiked slightly. It's a cool off, but no, it's still maintains at 83.3. Basically, it's being controlled by the central bank. But we have a weak rupee and a spiking dollar. Crude oil is at the very top, but we have 4% down. Last week was very hopeful. Crude oil is at 82 is good news, but it had spiked up substantially. And we can see that it's very top, and last week was a relief if it managed to maintain that, and it's in sideways and falling momentum, which is some kind of relief as far as our bottom economy like ours. Gold is at all-time highs, and once again it shows a green close and momentum is in the heavens and spiking up, which gives a worry that probably money is getting shifted to safer havens. So that's lots of great news, along with the rising dollar and rising crude in the sense crude is at the very top. This week was okay. No spiking on dollar, spiking crude and spiking gold. And look at the US markets. The US markets has fallen drastically, 6% fall on Dow Jones, and previous week total fall from the very top is 6%. That's what I meant. Last week was flattish on Dow Jones, but look at what has happened on the Nasdaq and S&P 500. It had not corrected as much as Dow Jones did, but last week it was nearly 5% correction on the Banknifty and 3% on S&P 500. So sideways momentum and falling is what the global indices are showing now. So that gives us the worry as to if this correction may extend. Remember, these markets had been rallying just like others, and it's the very top, and then now a placement of trade of 6% has happened. So that gives us a worry as to if this may extend further or not. So you have to be cautious about the facts. In a nutshell, we have trouble. We don't have good global cues when the US market is red, and we have crude oil that's at the very top of a trendline channel, and dollar is spiking. Right? Also keep in mind that the Fed interest rate hikes news is coming into March 1st, so there can be a lot of volatility due to these factors. Having analyzed many of the things, let's move on to see what's the actionable. Two stock picks on the long side itself. This one is Nalco. Have tight stop losses, very tight stop losses, because it has broken out and then substantially moved. The market is in a correction mode. Metal is the only sector where we can invest as of now, as per the analysis that we did earlier. So normally is bullish, trend is bullish, volumes are good, pattern is a flag, potential for a further breakout, which would give reasonable risk reward. Okay. Second one is a Motherson Sumi, which is having bullish momentum and bullish trend, and have very tight stop losses. If this breakout sustains the upper handle, it can move substantially, giving a reasonable reward. It's a swing trades for 1 or 2 weeks max. That's all. Doesn't happen, come out. Have tight stop loss on all of those. Those are the two actionables. And third one is on the Nifty. This is a double diagonal collateral spread where we are selling put and call options for OTM, and we are buying hedges for OTM again on both sides for the upcoming weeks, 1 week ahead. That way we'll get the volatility advantage also. And risk reward is reasonable as long as you exit before the expiry day. 1 day before at least, and the range is reasonably good. 21,700 and 22,700, 1,000 points range we get, and 21,700 is a previous single low. Remember that 21,700 is near the all-time highs that we had. Very good range, reasonable risk reward if you exit early. And if you want, even if this fails, if you want, you can roll down and roll back and adjust it. But this is completely risk defined. Even if you exit, if you have a trade plan with an exit, if breaches, it can be rewarding, is what I feel like. Yes, so that's the double diagonal collateral spread strategy weekly on Nifty. Let's just wrap it up now. So market had fallen down further as compared to the previous week, and it was a gap down from near the all-time highs, and then a quick bounce up happened, recovering half of that fall last week. But still it has not given a confirmation of an end of correction. Okay. And having there was a short-term dip in the momentum of the trend, and it continues to the dip is evident, and with the fact that it's still below the 20 exponential average, but it's holding the higher high and higher low pattern intact with a 4.5 to 8.5 correction, the 26 to 35% of rally that is long behind the multiple flat patterns after a cup and handle pattern breakout. Let's just put it in buckets of bulls and bears. What's in favor of what? Bulls, it's a piercing pattern, bullish in nature with daily charts. Open interest is bullish, PCR is bullish, close to almost. 20-week expression average is still intact. Well, the bands is contraction, not bearish expansion downside yet. Higher high, higher low pattern is there. mid cap and small cap account, no, less of recovered. Sector and raises maintain the sideways, no, except for the IT. VWAT stocks are also maintaining the sideways or bullish, not bearish yet, most of them except the IT. VIX is still low volatility, no, not, it does not go to 1650, but the moment it goes, things have changed. So we have the factors in favor of the bulls, but what's in favor of the bears is the fact that the foreign institutions are selling more. We have reversal price action patterns. There is a possibility of a shooting star three candle pattern that could work out. It's confirmed as of now. Use markets are right. Dollar is spiking, gold is spiking, gold is also spiking. So these are all the factors. Global cues are not in favor basically on the bears. Alright. So basically following the global cues last week, as I said before, the market had gapped down from near the very all-time high levels, more than that, and then it recovered half of that quickly last week itself. The correction still less than what was the previous correction. That way the higher low is been still maintained. And the question is, will the correction further extend? If it extends, how far it could extend? The longer it extends, more time it will take to move. So it is, as per Bollinger Bands, would it be contracting? Would it be consolidating and then moving sideways for a long period of time? How long would that be? Whenever we have big events that are coming in, Fed rate cuts in May 1st, election outcomes, and the Middle East crisis, news flow is negative, still floating around. So markets can be very volatile and unpredictable. All we can do is manage the risk and then study the potential areas of resistance and risk, and probabilities of supports. That's all we can do. That's what we're doing technically. Technically, there is no confirmation that it will happen. It's still it's just seeking the probability of resistance and support. So that's all we do. So technically, it's out just sideways, right? With trends having had not crossed back to bullishness yet. So it's a neutral sideways view that I have with mild bullish bias also is there, given the fact that we have a big bounce that happened on Friday. So as I said before, the global cues, recession fears, inflation fears, interest rate hikes, war, COVID, and all these things could screw up things, create black swans and all that can happen. You have to be cautious about all this. Of course, in the sense, you just have to have portfolio level stop losses and manage your portion size accordingly when the VIX is spiking. So 21,500 and 22,500 is where the Nifty levels are there, as predicted for the next week, as per my analysis. 46,500 and 48,000 is the range where the markets could move in the next week on the Banknifty. So as long as this 22,000 and 48,000 is maintained, we still can hope for the continuation of rally. But have tight stop losses and then play it safe. Also, overnight risk, do not take that unless you hedge. Don't play it on the options and derivatives. Vertical spreads, tight stop losses, and you can use non-directional OTMs unless until the direction is clear. As if now it's sideways, we don't know the direction. Although it's not that favorable for the option sellers, still that's the only way to go. Hedge your strategies properly, or even the investors can use this opportunity to buy niche type SIP mode long-term investments, or you can use option strategies to make rental quicker come, right? If we have invested already done on this. That's all I have for the next week. I'm active in this channel. If you want to subscribe, you can do that. If you like, you can put in, like and put in the comments and feedbacks and all that. Thanks for watching. Happy trading, happy learning, happy investing.